Okay, we're ready to continue. We're in for the final stretch now for the afternoon. Next, we have Professor Amedeo Arena from the University of Naples, Federico II, who will be discussing the European tax ruling saga before the EU Court of Justice. Amedeo?
All right. So, good afternoon, dear survivors. We're still here after a very intense program. First of all, I'd like to thank my host Walid for the kind invitation and the excellent organization that really makes me want to come back to Riga once it becomes ready to sustain life from Southern Europe too. So it's a lovely place and I really look forward to our cooperation. As a matter of fact, I think we can consider this in my presence here as part of an ongoing Erasmus agreement between Riga and the University of Naples, Federico II, and I hope there will be other opportunities for exchange of lecturers, exchange of students, and whatnot. So today's topic deals with the European tax ruling saga. We'll see in a minute what that is about. So essentially, the secret deals that allegedly, and the word allegedly will recur in this presentation because the cases are still pending before the European Court of Justice, and also because I see there is a live stream there, so I don't want to be sued by these companies. And so they apparently got these very good deals from some member states in order to increase their presence, their investments in some member states, in exchange, let's say, for favorable tax treatment. Okay, so this European tax ruling is based on the concept, of course, of tax ruling. What is that? It's a prior binding decision by a tax authority as to how tax provisions will be applied to a given taxpayer or to a given transaction. So the implication behind this is that tax law is very complicated. So sometimes taxpayer wants to know where he or she stands in respect of tax law. I would like to know that in advance. This kind of instrument is particularly useful in the case of transfer pricing. So taxpayers can get these advanced pricing agreements, prior binding decision as to what transfer pricing methodology will be applied to an intra-group transaction. So before we proceed any further, may I ask you honestly how many of you are familiar with transfer pricing? One, half and half. All right. So I beg my apologies for the ones who know what a transfer pricing is, because I'll give a bit of a transfer pricing 101 so that we get all more or less on the same page. Let me point out that I'm not a tax lawyer, so that is not my background. My background is more in competition and state aids. So this is how I understood transfer pricing, and I hope I'll be able to convey this to you. So help me out here. Suppose that there are two sister companies, one in France, where we have corporate tax rate of 33%, and one in Bulgaria, where taxes are 10%. Each has a profit of 100. So how much does the French company have to pay? 33. It's written there, by the way, yeah, but you're right. And the Bulgarian one, 10, of course. So total tax, 43 for the whole group. But now, start to think as a real multinational. How can you optimize that? Well, let's say the Bulgarian company buys an asset, I would like to say in competition a widget, whatever there is, or blodget, if you prefer, for 20, and sells this blodget to the French sister company for 100. Now, what are the profit of the French company? 0, so tax 0. Bulgarian company, however, got richer somehow. So 180, because you have to detract 20 and add the other part of the price, and so essentially total tax will be 18. So you see, if you start to think as a multinational, then there are opportunities to save costs. Too bad that tax authorities considered this thing long ago, and so many of them, they introduced a thing called transfer pricing, which is applied in line with the principle known as the arm's length principle. So essentially, they tried to see what the honest price, the realistic price of the intragroup transaction is, typically by comparing it to similar transactions that take place between independent undertakings. So if it turns out that the company concerned sells the same blodget to its sister companies at 100, but to other companies on the market at 30, then guess what? The price of 100 is replaced for tax purposes with the price of 30. So not to allow this kind of revenue sharing and transfer of revenues to low tax jurisdictions, and the ensuing tax savings. However, As you might have understood, I'm really simplifying here. The process of arm's length pricing, of deciding what the realistic price of that transaction should be, can be in fact very complicated. Also because there is not always a transaction we can compare it to. So for example, let's say that this company only bought and sold this commodity to the sister companies, but it doesn't sell it on the market. So how do you assess the value of that? Well, it can become more complicated. This is why you can ask for an APA, Advanced Pricing Agreement. So essentially you go to the tax authority and tell them, well, you see, this is how I calculated the price of my infragroup transaction, see if it's okay with you. Well, then the tax authority reviews that, especially reviews your transfer pricing report, which is essentially how you explain how you got to that number in particular. And the tax authority says, okay, that is fine with me. So that will be the final price for tax purposes. You don't have to worry about it. We will replace that at a later stage. Okay, tax rulings were introduced possibly first in the United States. This was one of the first jurisdictions that introduced that instrument. But turns out they're not very popular there. Companies do not get them many, or very, very often. And so there have been some very, very interesting, though in economic studies, as to why they are not popular in that country. Well, let's put it this way. From the perspective of a taxpayer, seeking a tax ruling has advantages and disadvantages. The advantages, of course, are increased legal certainty, so you want to know where you stand, and most importantly, avoidance of sanction. So you're sure you apply tax law in the right way, and you will not be penalized because you essentially do what the taxman says it is okay to do. However, there are reasons against. So first of all, the direct costs. So sometimes, actually quite often, tax authorities, they ask you for a fee to get a tax ruling. And also, and most importantly, tax rulings tend to have, in the United States, where they are public, and that is very important. You can easily find them on Westlaw, LexisNexis, on one databases. They tend to have a de facto precedential value. So even though the law says that tax rulings should not be cited as precedents or employed as precedents, the Supreme Court has also said that there is something called the principle of equal treatment in taxation. So now, suppose that there are two possible interpretations of a tax rule. One more favorable to the taxpayer, one more favorable to the tax authority. Now, in the context of an audit, well, the audit is confidential. So even if the tax authority applies the interpretation more favorable to the taxpayer in that context, well, nobody will find out, and so there is no duty to extend the same treatment to other taxpayers. But tax ruling, as I said before, they are public. So essentially, if a tax authority picks the interpretation that is more favorable to a taxpayer in a tax ruling, then it is somehow bound to apply the same favorable tax treatment to all the other taxpayers, the significant loss in tax revenues. Knowing this, many companies prefer to try their luck with the subsequent audit rather than get the earlier tax ruling, because they believe that the authority in the context of tax ruling may be, let's say, more strict than it might be in the context of a subsequent audit. So this is the reason why they're not very popular in the US. But in Europe, we, until recently, did things very differently, because tax rulings were secret, were confidential. So let's say that an alternate use of tax ruling became possible, at least according to the European Commission. So the tax ruling were used by member states, allegedly, not to provide legal certainty as to the fiscal treatment of a certain transaction, but to grant a firm lower taxation than other firms in a similar situation in return for increased investment, the creation of jobs, increased commercial presence in the member state concerned. That is the so-called alternative use of tax ruling. So, for example, going back to the previous transaction, then you approach the tax authority. You promise that you will create a new establishment there in that member state that will create new jobs. And then you say, well, my transfer pricing is 100%. And the tax authority says, okay, that's fine with me. And then you ask, but don't you need a transfer pricing report? And the tax authority says, no, you look like a trustworthy guy. No, we won't be needing that. Allegedly, that's what seems. Okay. So, but why would a state do that? Why would the state decide to reduce the tax obligations of some companies in particular? After all, they are surrendering tax revenues, resources. Well, because there is such thing called tax competition in Europe that is still possible, considering that direct taxation is a competence of member states, not of the Union. And so how do you attract multinationals, big investors? Well, one way is tax cuts, okay? And tax cuts, indeed, have been very fashionable. As a matter of fact, over the last 10 years, the average level of corporate taxation went down from 35% to 23%. But that typically poses a prisoner's dilemma. So if you do that, then probably other member states, here, of course, it's just an example, then they may have an incentive to undercut your tax treatment. And so while everyone would like to get in the bottom left square on the top right square, so essentially that you get 10 because you are able to attract investors while the other member state is unable, then if the dominant strategy is imposing lower and lower taxation, you typically end up in the bottom right corner. So essentially everyone is applying a very low tax rate, and that is apparently not good for the public coffer. So how do you win this game? By cheating. So you apply, let's say, a reasonable tax rate as in general, but then you apply a lower tax rate, sometimes an extremely low tax rate, to one or more international investors in particular, so as to get the best of both worlds. You attract international investors, and then you do not have to surrender your tax revenues vis-à-vis other taxpayers, and most importantly, you don't risk triggering a tax war, because maybe other member states are not aware of that particular practice. How did this come out? This has been going on for a while, but it mainly came out thanks to the LuxLeaks scandal that exploded in November 2014. So as a result of this, by the way, the Consortium of Investigative Journalists, they still have a website with database when you can look for the tax return of your favorite company if you want to see how it looks like. And there are many, many of them. So the Commission eventually opened 9 formal investigations. 6 of them were closed with recovery decisions. So it means that the European Commission found that there were illegal state aids and ordered the member states concerned to recover these aids. 2 of them are still pending, and 1 instead has been, let's say, dropped by the European Commission. So the European Commission spontaneously decided that despite the allegations, there were no aids, and that was the McDonald's case. Okay, so this is the scoreboard we can see of the decisions that were closed with recovery decisions. So we range from Fiat and Starbucks, who apparently already received benefits of only 25 million euros, to a whopping 13.9 billion euros, plus interest, of course. That is what allegedly Ireland gave Apple. Now, we'll only examine 2 cases, but in case you're curious, you can ask me at the end of this to look into other cases. So my favorite is Starbucks Netherlands. So what happens? Starbucks Netherlands provides roasted coffee powder and also coffee-related products, mugs, cakes, and whatnot, to all the Starbucks outlets that are in Europe and I think also in the Middle East, if I'm not mistaken. So as you might imagine, then Starbucks Netherlands has significant revenues, because essentially that's where all Starbucks Cafe buy their coffee from, right? But remember that in taxes, you pay taxes not on your revenues, but on the difference between revenues and costs. And somehow Starbucks Netherlands got from the Netherlands authority some tax rulings as to how to calculate their costs. Well, the first cost, roasting coffee, so essentially you need coffee to roast. Green coffee beans, that's the case. And Starbucks Netherlands apparently bought these green coffee beans from its sister company in Switzerland. Now, do you see what color are the beans there? Yeah, as a matter of fact, they should be golden, because according to tax ruling, the margin of the seller increased 3-fold over a short period of time. So if you're looking for a good investment, forget blue chips and invest in golden beans. Not bad, right? But that's not the end of it, because in order to obtain roasted coffee, then you need the coffee beans, and you read the roasting technology know-how from your sister company, which is a letterbox company, by the way, Alki. Now, being Italian, I thought that coffee roasting is something like common knowledge, like cooking pasta. Then I went to the UK and found that it's not so universal knowledge after all, but that's a story for another day. However, it turns out that coffee roasting is somehow like quantum physics, because what is the value of the coffee roasting know-how? I don't know, but according to tax ruling, 1 year it was 1 million euros. Okay, fair. Another year it was 14 million euros, so maybe there have been some huge breakthrough in the process, I don't know. Some other years, and that's my best part, it was a negative royalty. So it is as if Netflix were paying you to watch the shows. Not bad, right? So that is not me again, this is the Commission that believes that maybe these numbers do not reflect the real market value of the process. Also, please consider that this coffee roasting technology only in Starbucks Netherlands pays for it. No other companies in the world pays for it. Not even the other companies that are not part of the Starbucks group to which coffee roasting is outsourced. So, okay, so the Commission idea is that these prices, they do not reflect the real market value, but they're just there to offset the profits of Starbucks Netherlands. So as you can see, the taxes paid to tax administration in the Netherlands are just these 2 coins here, so a very low amount. And then a famous Apple case. So the way the Apple structure is organized in Europe means that essentially when you buy an iPhone in France, in Germany, well, it is, as a matter of fact, a sale concluded and profits are recorded by Apple Sales International in Ireland. So first of all, we have a concentration of all the revenues in a single member state. So far, so good. Then, according to some tax rulings reached with the Irish authorities, apart from a part of these revenues that are paid to Apple Incorporated in the US for R&D, because research is an important part of this process, then most of the profits are transferred to the head office of Apple. That is, has no premises, no buildings, you see, somewhere in the cloud, maybe iCloud. Okay, and thanks to this, according to the Commission, allegedly, Apple managed to save 13.9 billion euros over a period of 10 years, and that's the amount because the Commission could not go any further in the past because there's a 10-year limitation period. And so just to give you an idea, in 2014, according to the Commission, Apple allegedly paid 0.005% of its revenues. So essentially means for each million euros you only pay 5,000 euros. Not bad. Okay, these decisions are, of course, now under review by the General Court of the European Union. But let's see, before that, how the Commission went after this kind of practices, because, as I said before, there is no union competence in the field of direct taxation. So how is the Commission going to intervene? Well, the Commission took advantage of Article 107, paragraph 1, which is the ban on state aids. So you can read the text there, but I think it's better to have a look at the advantages that legal scholarship and the Commission itself has somehow inferred from this definition. So to have a state aid, you need 4 cumulative requirements. All of them must be there for the Commission to actually proceed and consider that a state aid. So first of all, the aid must entail an advantage for the recipient. That is pretty obvious. So the advantage, the recipient must be better off after the aid than it was before. Then the advantage must be selective, and that is a very controversial requirement. So it is not an aid if it applies to everyone in this room, only if it applies to some. You see, otherwise it's a general macroeconomic measure that is still within the competence of member states. Now, sometimes, and in particular in the case of tax rulings, the European Commission looked at these 2 requirements together as a sort of cumulative test, the selective advantage test. So they conflated 2 requirements into one. Then there should be imputability to the state, so the aid must be imputable to the state. It is the state that has to provide the aid through state resources. And finally, this aid must distort competition and also have an effect on trade within the European Union. So let's see how the Commission applied these requirements to the particular case of tax rulings. So first of all, how do you show that the tax ruling granted an advantage, that it gave a better tax treatment? What is your benchmark? Well, according to the Commission, it is the arm's length principle. So the tax ruling, they grant an advantage if they endorse an unreliable approximation of market-based outcome that is not in line with the arm's length principle. Essentially, if they treat infragroup transactions differently than transactions between one company and another independent company usually are treated. That is essentially a very simplified version of that. However, as you can understand, it is quite difficult to actually define that. So from the various decisions of the commissions, we can infer some red flags, so some kind of factors that typically attracted the interest of the European Commission and as a possible violation of the ALP. So first of all, the absence of a transfer pricing report. So usually it is, let's say, not complicated, but it's a bit of a challenge. You go to the tax authority with your own calculation of transfer pricing, and then you have to provide this transfer pricing report to convince the authority that your calculations are okay, are accurate. Well, in many cases, these tax rulings were given without a transfer pricing report. So they seemed a bit benevolent, the authorities, vis-à-vis the taxpayer. Most importantly, in other cases, the tax rulings were conditional upon the taxpayer investing in the member state concerned or creating jobs there. So, since there is no such thing as a free lunch, except maybe for this conference, yes, but then this raises the suspicion that if the taxpayers are to give something, then maybe they also got something in return, possibly a more advantageous tax treatment. That is, again, the thesis of the Commission. And then, especially in the earlier decision, but the Commission eventually sort of dropped this, that the tax rulings are not in line with the OECD transfer pricing guidelines, that, let's say, they represent the state-of-the-art science in the field, in this arcane field of transfer pricing. Okay, now let's examine, I will do this for each prong, the challenges that have been raised by the critique that has been raised both for legal scholars and from the companies concerned and from the member states concerned before the General Court. So the first challenge is that this AALP principle is not a part of EU law. Then if you look at the body of EU legislation, well, we cannot find something that really speaks of the arm's length principle. Except from maybe recently from the working paper on state aids and tax rulings that the Commission issued. But again, it is not binding legislation. However, it turns out that the Court of Justice applied that principle, although impliedly, in this judgment called Forum 187, claiming that the way the tax responsibility of a coordination center was calculated, let's say it did not reflect the conditions of free competition. So it was somehow distorted. So the Commission believes that there is a sufficient legal basis to create, to read into Article 107 this principle of arm's length principle. Also, the way the Commission presents it, according to the Commission, this is just a corollary of equal treatment. So aids are only prohibited if they are selective, essentially if they entail a discrimination between between beneficiaries and undertakings that are in a similar situation. In the field of taxation, that means that all taxpayers must be treated in the same way. And so this ALP just makes sure that multinationals are treated in the same way as standalone firms. So you see, it is a bit of a convoluted reasoning, but essentially this is the argument of the Commission. And then the other argument is, yes, okay, but this ALP is not part of national law. So essentially I got this tax ruling from Ireland, for example, but if Ireland has not implemented that principle into national legislation, then why should Ireland have taken that into account when giving the tax ruling? Well, the answer is because if the ALP is part of Article 107, then 107 is directly applicable in the member states, even if it's not implemented. Besides, as the Commission observed, it would be too easy to circumvent Article 107 by failing to implement the ALP into your legal order. That's a bit of an estoppel argument, that member states should never be able to profit for their lack of doing something, essentially. And then also this quite old principle, but is valid in many fields of EU law, from criminal law to tax law, that even if a competence belongs to member states, they must exercise in a manner so as not to infringe EU law in other domains. And that is apparently the Commission argument. So taxation is still for member states, but they must not apply it or modify it in a way that violates the ban on state aids. Selectivity. So again, this is a very important requirement because it's the conceptual watershed between member states' economic policy, macroeconomic policy, again, that's just coordinated at the EU level, and instead EU competition policy in the field of state aids, which is an exclusive competence of the European Union. So for fiscal aids, typically the Commission has adopted a three-step test. So first of all, the Commission has to define the reference system. So what is the reference system? Corporate taxation, okay? Then, is there a derogation for a reference system? So are there companies that have a more advantaged application, benefit from a more advantaged application of corporate taxation? Possibly. And then the Commission looks at a possible justification. So maybe this differential treatment has some kind of justification or not. And then this is how the Commission establishes the presence of a fiscal aid. However, that's not what the Commission did in this case, at least not initially, because the European Commission used another test, the selective advantage test. So they conflated the two requirements together. This has been challenged by many actors, including the US Treasury, which issued a very nice and possibly unprecedented white paper, arguing that the Commission misapplied EU law. In particular, they claimed that the selective advantage was invented by the Commission as a new test to target US firms. So you see, they created a new test just to disadvantage, undermine US firms. Well, at the time I was reading this Tyrrhenia case, totally different case, concerned the sale of certain transport ships, and then the issue was whether the price reflected market conditions or not. And guess what? There, the Commission also applied the selective advantage test. So, and that test, I can also tell you, I've done a bit of research, has been used long time before this tax ruling case, so you cannot really say that it's a new test. The Commission, according to the European Treasury, instead of looking at one test, selective advantage, should have examined the advantage and selectivity separately. So that is the argument of the Treasury. Turns out there is a judgment, Commission versus Moll, that says that when the aid is individual, well, if you prove advantage, selectivity is presumed. So let's say that you're all my employees in a company, okay? And then I decide to increase the salary just of some of you. Then in that case, you have to prove somehow selectivity, so that there is a class of advantaged people. But then if I just pay Walid a higher salary, well, the aid is selective by definition. So if I give him a higher salary advantage, then it is presumed that the aid is also selective because no one else got it. That is the kind of reasoning. However, and this is my favorite argument, just I think close to the publication of the Apple decision, of the press release, Tim Cook, the CEO of Apple, sent a message to all European consumers in which, among other things, he claimed that we just followed advice from the Irish tax authorities, advice that was open to all other companies operating in Ireland. So they got 0.005% in 2014 just because they asked. But everyone else could have asked and received exactly the same treatment. I don't know, I've tried with the Italian tax authority. Can I get the Apple treatment? They told me no. But okay, anyway, I will leave that to you to determine whether that is the case or not. Legally speaking, there is a judgment that is relevant here, War Duty Free Group, according to which if an aid is a priori available to all firms, the Commission, to prove selectivity, is under no requirement to identify the class of beneficiaries. So this makes things a little bit easier for the Commission. And let's turn to the other two requirements. So in this respect, I have to be a little bit critical vis-à-vis the Commission, because the Commission dealt with this requirement in just one or two paragraphs, did not spend a lot of time on those. If you think about it, because they look pretty obvious, are tax rulings imputable to member states? Well, they were issued by member state tax authorities, so I guess yes. And finally, were state resources involved in tax rulings? Well, if instead of applying, let's say, 30% tax rate, you apply 0.005, well, in a way, you are using public money to finance the tax rulings because you are surrendering potential fiscal revenues. But, of course, both of these statements were challenged before the General Court. So the first argument is that, as a matter of fact, tax rulings optimize the recovery of fiscal debts by preventing the delocalization of mobile taxpayers. So some taxpayers are like Leonardo DiCaprio in the movie Catch Me If You Can. They are very movable. So if you don't give them a 0.005% tax rate, they will move to Luxembourg, and so you will get zero. And zero is less than 0.05%, right? So in a way, member states were compelled by tax competition to do so. The Commission, let's put it this way, is not totally opposed to this idea. Indeed, the Commission allows tax amnesties, condoni. In Italy, we have a bit of experience in that respect. But the Commission only allows that under certain conditions. That, in particular, tax amnesties, they are open to everyone, they are applied in an objective manner and in a transparent manner. Conditions with which secret tax rulings do not exactly seem to satisfy, at least at first sight. And then the other argument is that, okay, yes, we surrender some tax revenues, but as a consequence of the big multinational investing in our own member states, then we have created the new taxable transactions. First of all, other companies establish themselves in that member state. Second, all additional employees now live in that member state, and probably they wouldn't have been there if it was not for the tax ruling we gave. Well, in Italian banks, the Commission, so again, its point of view, maybe it will be overturned by the court, said that this really doesn't matter, so you have to examine just individual transaction where apparently you gave a more favorable fiscal treatment. There was the case of in the Italian banks, where apparently the Italian government gave some sort of tax advantages for mergers involving banks. And the argument of the Italian government that, oh yes, we reduced the tax on that transaction, but as a result we had many more transactions, well, that argument didn't really work, so you have to regard to the individual transaction. Distortion of competition and effects on EU trade. So the purpose of competition law is to create a level playing field, not exactly like that one, between companies in the European Union. So they should have, more or less the same conditions of competition to compete on the merits, right? And again, the Commission did not spend a lot of ink in this respect. They just claimed that the tax rulings concerned, they strengthened the financial position of the beneficiaries relative to competing undertakings. So one company has to pay all its tax, another company has to pay all its tax minus 13.9 billion euros. So this gives the latter company a financial advantage over competing companies. And then, in respect of the effects on EU trade, again, the Commission did not spend a lot of time on this, just claimed that any aid to multinational companies, let's say almost by definition, can have an impact on trade at the EU level. So not only at the local level, not at the national level, but at the EU, if not at the global level, as a matter of fact, which, again, seems pretty intuitive. But these requirements have been challenged too. This is my favorite argument. So when I gave this talk in Stanford, some economists there relied on the Modigliani-Miller theorem. So the idea that the value of a company is not really influenced by the way it is financed. Now, that by admission of these economists, that theorem has very strict requirements, one of them being that all the people concerned believe in that theorem. And that turns out not to be the case, because one of the few cases in which the European Court of Justice annulled a Commission decision for not showing sufficiently how it would distort competition was a Liu order. And so the burden of proof to show distortion of competition is a very low one, and does not necessarily rely on the Modigliani-Miller theorem. So let's say, put this way, maybe economists believe that getting 13.9 billion euros and not getting it will not make any difference. But let's put this way, all other people believe that it makes some difference, as a matter of fact. Oh, and this is another nice argument I've read in legal scholarship, so in legal literature, that as a matter of fact, group companies, they are in a different soccer league. They do not compete with individual companies, So there are two different leagues. For example, they said Apple only competes with Samsung. They does not compete with the local or national company that operates in the same business. Well, from the competition law point of view, this argument seems to be a little bit untenable, because if the relevant market from the product point of view and the geographic point of view is the same, then there can be some competition, as a matter of fact. And I think this is clearly explained by the Starbucks case. So until recently, we did not have Starbucks in Italy. Now it opened in Milan, and the kind of coffee they serve is more similar to the one above, which is what in Italy we can usually get for 90 cents. And not like the one below, which is usually sold for about $3, and as you can see, is a bit different. Then I leave to your interpretation which one you like, of course. But I think the fact that Starbucks significantly changed its market conduct in a market such as Milan shows that there can be some competition between the giant, between David and Goliath, as a matter of fact, and therefore that if Goliath were somehow to raise its prices as a consequence of this recovery obligation, then it's possible that some of the consumers, some of the customers of the giant will switch to the local company or the national company. As a matter of fact, please remember that Italian bars making the product above, they do not usually receive tax rulings because they are not multinational companies. So I think there can be some competition. And finally, and this is another argument I've read many times, I also heard from some of the lawyers of these companies, many of the lawyers sometimes are also academics, so the two things are not mutually exclusive. Essentially, this is the defense. Okay, maybe that state gave illegal tax rulings, and so what? Everyone else is doing it. If that state didn't do it, then again, other state, that company would have gotten same ruling or a different one from another member state. Well, I don't know. If they stop you for speeding, do you think it's a good argument to say, but police officer, why did you stop just me? You see, everyone is speeding. Well, I leave that to you, again. What I can tell you is that from the legal perspective in Commission versus Italy tax credit, the Court of Justice took the view that trying to approximate by way of unilateral measures the situation in one member state to the situation prevailing in another member state does not deprive that measure of its character of aid. So even if it's with a good intention of ensuring fair competition at the tax level between member states, it is still an aid. But most importantly, the Court of Justice clarified, not really yesterday, but in 1964, that a member state can never claim that EU institutions or other member states are not complying with EU law as a justification from infringing EU law itself. Finally, what happens now? Well, as you might know, there is no real sanction for infringing state aid rules. The only consequence is the obligation to recover these aids and recover them plus interest. So, in this case, the sum to recover is equal to the tax that the company should have paid without the tax ruling, minus the tax the company has already paid under the tax ruling, plus interest. And as you can see, that amount varies, ranges from 25 million to 13.9 billion. Of course, also this recovery obligation has been challenged before the General Court, and this is, I think, the core of this talk, because one of the arguments that was raised, and an argument that may have some merits, as a matter of fact, is the principle of legitimate expectations. So this is the first time ever the Commission is going after tax rulings. It has never done that before. So how was the company supposed to know that that kind of rulings constituted an illegal state aid? It is a violation, allegedly, this time on behalf of the companies, of their principle of legitimate expectations. They believed it was legal. Now, what is the source of legitimate expectation? Well, it can be both the member state that gave the tax ruling, say, don't worry, it's perfectly legal, you get a very nice tax ruling, or the European Commission. Now, the first case, although it may seem harsh, the Court of Justice has long ago clarified that the source of legitimate expectations in the field of state aids can never be the state granting the aid. Why? Well, it is obvious, because otherwise there would be no such thing as a prohibition of state aid. Because every time you could claim, no, but the state told me it was perfectly legal, right? Then maybe the source of legitimate expectation should be the behavior of the European Commission, which should have given precise assurances as to the legality of a certain behavior. Now, the argument is that since the Commission has never really applied Article 107 to tax rulings before, it sort of gave the impression that that practice would be legal. As a matter of fact, tax rulings, the alternative use of tax rulings, I suspect, is not really something recent. It has been going on for quite a while. So, would that hold in court? Well, I understand why firms are raising that point, but as a matter of fact, in 1998, in the Commission Notice on Direct Business Taxation, the Commission had expressly pointed out that discretion on the part of tax authorities, namely in giving tax rulings, could give rise to illegal state aids. So let's put it this way, somehow the companies were warned. Now, of course, it is a matter of debate, and we'll see how it ends in court if that kind of provision in the notice was enough for companies not to legitimately rely on the legality of the tax rulings or not. So we'll see how it goes. Then the other argument is that the beneficiary of the tax ruling would have created less taxable income if it had known that the tax ruling was illegal. So if I had known that the 13.9 million euros I would later be required to give them back, then maybe I would not have created such a significant commercial presence in that member state. Maybe we would just open a shop or two, but not my base of operations. Well, as this famous Italian chef on British television program said, if my grandma had wheels, she would have been a trolley. So essentially, this kind of counterfactual reasoning doesn't apply in this case, and that was clarified by the court in Unicredito. So recovery of state aids means restoring the status quo. And restoring the status quo just means giving back the aid, not reconstructing the past on the basis of the hypothetical choices that the company concerned would have made. Because essentially you would need a time machine there. It would be actually quite difficult. And then the argument is, okay, maybe it was a illegal state aid, but then in that case, we also owe money to the tax authorities of different member states. Well, the Commission totally agrees with this argument, and in the Apple decision in particular, it expressly noted in a footnote that Apple might be liable for part of the 13.9 billion euros also to the Italian tax authorities. I really hope the Italian tax authorities read the footnote. But anyway, the consequence of that, so where Apple has, to pay 1 billion euros to Italian tax authorities, then that sum will be subtracted from the rest of the sum that Apple has, according to the Commission, to give back to Ireland. And then this is another, I think, interesting aspect, paradox. Put yourself in the shoes of the member state. So if everything goes well, you surrender part of your tax revenues, but you attract multinational investors. Then, if things go south, you attract the multinational investors, plus you recover all the money that you gave that investor to establish itself in your state. Not a bad deal. So some have argued in the European Parliament that the obligation to recover state aids, far from being a sanction, is a sort of a de facto reward to member states for failing to comply with state aid rules. So even some of them even advanced the proposal that there should be sanctions for the member state, or that the sum recovered should accrue to the EU budget rather than to the member state concerned. So do we really need that as a deterrent? Well, in my humble opinion, not necessarily, because transparency can be a sufficient deterrent. So let's put it this way. From the perspective of the firm, you're all interested in getting a possibly legal tax ruling if the expected value, we will see what that is in a minute, of the tax ruling, plus the compensation, so the investments you pledge to do in the member state, are less than the full tax. If it's not the case, then you just be happy to pay the full tax. What is the expected rule of the tax, or the expected value of the tax ruling? Well, it is the reduced tax that has been offered by the tax authority of the member state, multiplied by the probability of not getting caught by the Commission, plus the full tax and interest, multiplied by the probability of getting caught by the Commission and having to pay back your fiscal advantage. Now, the two probability factors, they add to 100%. So if there is a 30% of getting caught, there is a 70% of not getting caught. That is quite obvious. And also A can be defined as the difference between the full tax and the reduced tax. That's the fiscal advantage you actually get. So if you crunch down the numbers, it comes out then the expected value of the ruling plus the compensation is less than the full tax, only if the probability of getting caught is less than the advantage minus the compensation divided by, because that's minus 1 over there, the advantage plus interest. So in practice, let's try to put some numbers into this formula. If the full tax is 100, the interest is 10% of the fiscal advantage, and the compensation you pledge to do is 40, if the probability of getting caught is only 30%, then the reduced tax must be 40 or less. But if the chances of getting caught rise to 50%, which is not a lot more than 30%, then the reduced tax must be as low as 10. So essentially, the more transparency arises, the more member states have to promise. So this may no longer be in the interest of member states or in the interest of the companies concerned. Transparency sort of makes this kind of deal, impossible. And it seems that the Commission is entirely aware of that, because the Commission has proposed at least 2 directives that significantly improve transparency in this sector. They were, by the way, approved by member states by unanimity under Article 115 of the Treaty on the Function of the European Union. So the first one, 2015-2376, provides for the mandatory exchange of some tax rulings having cross-border implications between the member states and with the European Commission. So they are no longer secret, they have to be shared. This directive has been complemented most recently with Directive 2018/822, which requires tax planning intermediaries, that is, accountants, consultancy companies, and lawyers, to report potentially aggressive tax arrangements, including tax rulings, to their local national tax authorities. So again, this increased transparency, although one legal commentator has said that this kind of requirement reminds him of the law of terror of the French Revolution. Anyway, but I guess we can all agree that fair or not fair, this kind of arrangement increases transparency in this kind of deals. So is the man listening? By the way, that is from Better Call Saul, if you're a fan. Okay, so let's see what happens next. In all fairness, it is a close call. So it is difficult for me to predict whether the General Court and the Court of Justice eventually will uphold these decisions or will annul them. But what I think can be done at this stage is to sort of try to imagine what will be the consequences of the two possible outcomes. So if the Court of Justice annuls the decision, I think that will be seen as a reaffirmation of national fiscal competencies. The idea that the member states and member states alone can decide in how to deal with fiscal direct taxation matters. So that would imply a sort of a limited vision of the internal market, because within the internal market, companies are required not to infringe competition rules. So competition between companies is subject, in a way, to the law. Whereas tax competition between member states is pretty much free. That would be the idea. And so possibly that will also lead to a revival of the intergovernmental model as a solution to, let's say, aggressive tax planning practices. So the idea that there should not be supranational intervention in this area, but that all cooperation activities should be based on the will of all the states concerned. International model, if you wish. What if instead the court were to uphold the Commission decision? Well, at first, I think there will be a strong opposition by member states. So member states will not be too happy about that. Also, probably legal scholars and other political actors will strongly complain against that. But then I think in the medium term, what will happen is that member states will finally become aware that certain practices are no longer beyond the reach of the European Commission as an enforcer. So possibly that will compel them to sit at the negotiating table and possibly to adopt new legislation in the area of fiscal matters. If you think about that, since the first decisions, the first investigations on tax ruling practices were open, a significant number of directives has been adopted, and has been adopted on the basis of Article 115, that is to say, by unanimity. So, and that number was significantly higher than, let's say, the average number of directives adopted in the previous year. So this enforcement initiative has already been a sort of a catalyst for harmonization and for the adoption of legislation in this area. So possibly, if the court were to confirm these decisions, this incentive to legislate would be even higher, because essentially by legislating, member states will be able to somehow limit the discretion of the European Commission in that area. As a matter of fact, my background is competition law. That's more or less what happened in the field of merger regulation. So there was no merger regulation at the beginning. Member states seemed unwilling to adopt one. So the Commission started to apply Article 101 and Article 102 to mergers. Member states were not too happy about that, because they believed that that was not the purpose of these provisions. But eventually they sat at the negotiating table and they adopted the merger regulation. So legislation in order to protect, if you wish, certain transactions from the vast discretion of the enforcer. So I think that's a possible outcome. And in that case, there will be one more step towards a fiscal union, which I think is possibly the last and most important missing part of an internal market which has turned already 60. And this is my favorite slide, my city of Naples.
Thank you, Amedeo. Would like to take some questions. Anybody have questions for Amedeo? Lisa?
Thanks for a really interesting presentation. I'm scribbling down a few thoughts on my phone here. So I was wondering, do you see a role for big data or sort of greater transparency in helping to achieve maybe, a unified taxation framework? I would imagine one of the challenges, just thinking at your your equation slide that you presented is that there's likely to be a cost in terms of achieving that transparency and having sort of harmonization of how companies report profits. So do you have any roles on maybe how big data or greater transparency of data could be achieved in maybe a cost-effective way, or do you even see cost as a barrier to this at all?
Well, I think that that kind of initiative may have an effect in increasing transparency. So it is undeniable that if the Commission wants to do that systematically, it has to take into account all the kind of data, all the tax rulings that are exchanged via the automatic exchange mechanism. But in all fairness, I think that the end game of this will be legislative harmonization. So the Commission, although has been accused of acting as a supranational tax review authority, and supranational was not meant as a compliment in that memo, I think it's clear to see. Well, I don't think the Commission wants to play that role. As a matter of fact, the cases that the Commission selected are all high-profile cases. But I think, again, the end game and the solution also to ensure the legitimate expectations, again, of taxpayers, would be to have some kind of harmonization in the matter. And I think that's a possible outcome, again, of these enforcement initiatives that have been taken by the Commission, especially, again, if the decisions are upheld by the General Court and the Court of Justice.
Thanks.
Thank you.
Any more questions? No? Oh, sure.
Thank you for the presentation. It was amazing because I tried to read through those decisions a couple of times and I kind of grasped it, but not entirely. So thank you very much for this, making it very clearly. My question is about this potential outcome of the proceedings. Couldn't it be so that member states have, in fact, they've done everything to ensure that the judgment will not annul by the judgment, because this competence question has in fact been resolved by the adoption of the directives. And do you think that this was understood properly by the member states, that they will be influencing inevitably the court?
Well, I think the member states are aware of this possible outcome, as a matter of fact. Although, from a political perspective, it's sort of paradoxical. So member states are now challenging decisions that entitle them to recover millions and millions of euros. So put yourself in the shoes of a taxpayer of the member state. Would you be happy that your government is trying very hard not to recover money to which it's entitled and that maybe are needed for public services and stuff? However, in all fairness, I understand the position of member states. Member states, of course, are challenging this decision, first of all, as out of reputational risk. Because, come on, if the outcome is that the decisions are upheld by the Court of Justice, what other companies will ever accept a tax ruling like that, knowing that this could be the consequence? So first of all, they are defending the reputation. And I guess most importantly, in the medium run, they are somehow defending their sovereignty, or at least their competence in fiscal matters. Because as a matter of fact, I think many of them are aware that if these decisions are confirmed, then harmonization is the next step. And harmonization, by definition, implies preemption. That is to say, a limitation upon the competencies of member states. So it is an open game that can have, I think, significant competencies. I would consider this development as possibly the most important development in the fields of state aid since Altmark. And possibly, it will pave the way to the creation of a fiscal union, which is, if you think about it, a significant change to the constitutional structure of the EU as it is now.
Thank you.
Thank you.
Any more questions? No? Oh. Round of applause. Thank you, Amedeo.
Thank you.